Welcome to Advice from the Deal Room. I'm Ben Record.
Matt Russell.
Today, Matt, let's just paint a picture here. So it's the 11th hour, it's 4th and 1, or you got Marshawn Lynch sitting next to you, and you decide to throw it to Malcolm Butler. That's kind of what it feels like sometimes when a deal cuts all the way to the closing line and credit says no. So today we're going to talk a little bit more about who actually says no to a deal when it gets to that point. Why are no's said, and more about that.
Yeah, we've brought this up in prior podcasts and alluding to it on a few deals, especially some larger deals. And so we'll address those on here. We'll also just talk about what actually happens behind the scenes and why do they say no. And sometimes it's still sometimes a mystery why they say no. And we'll explain that too.
Matt, you used to work as a chief lending officer at a credit union back in the day. So I'm sure you sat on some credit approval committees. Give us a picture. What is that like on the bank side of things?
So over the years, I said, even when I was a chief financial officer, I was always part of the business loan committee on approving decisions. Honestly, you have a lot of people in the room who probably shouldn't be making some decisions like that. You have people in different executive positions sometimes, depending on the size of the institution. So everything is institutional size. Everything depends on the threshold for them and what layer of approval is needed to get that deal done. So there's a lot of dynamics that change from institution to institution. But generally speaking, when you get to a loan committee, you have some people that don't understand true credit, understand the risk of it is. But we get a package, a full write-up of typically, depending the size of the deal, 50, 60, 70 pages of a lot of crap. Not going to lie. We need to sum down into, and there's always a summary sheets with all these supporting stuff behind it. But when you get into it, you're reading the deal, and usually they're addressing risk. Here's the pros, the cons, strengths, weaknesses, whatever of the deal. And here's, there's weaknesses of the deal. Here's the mitigants of those weaknesses. All those are a nice summary sheet. The problem that gets into it is you'll have somebody in a credit committee that has been, they've been in this industry for 34 years and they got burnt on this type of collateral or this borrower, this type of borrower, this type of collateral, and they'll just shoot down a deal because of their bad prior experience.
Even though you've run this deal,
even though it's run through prior credit people, that are signing off and saying, yes, we've addressed all these. These should be approved the way we're presenting it. Sometimes it doesn't come into fruition like that. And sometimes you're caught off guard by somebody that you're just like, why are they making this decision? And their justification is, we don't like this because of back in the day on this deal, we got burnt. I've heard that before. A lot of it is, I would say sometimes it gets turned down in credit, mainly because it's not enough information up front that is provided in getting a green light from those people that will be making that decision. I know a lot of banks and credit unions, lending institutions have been changing how they work through deals so they're not caught at the 11th hour. They're not getting turned down. They are working through those in a way that, let's get these people, whoever's going to approve this deal, let's get them on board first. And so that's where the value of what we do is all the upfront information so there's not a surprise. Some things get turned down in a deal because there is a risk that comes up that was not originally presented, and it comes up later on in a deal, and you don't have that. Once it's in their minds and they go, well, everything's going great. Now this comes up, they get burnt. They don't want to get burnt. They just say no because they go, if we would have known this up front and there was mitigants put in place, then we can get through that. One recent deal where everything was great from the client. Everything looked good to us from what we knew at that point. All the information we knew got all the way through the process, and the spouse was guaranteeing this loan with our borrower, and there was some major credit problems on that spouse's credit report. And there were explainable things back, easy to explain, but since it was caught so late, that deal got turned down because we weren't forthright, we weren't open and honest about it, but we did not know. It was not transparent to us. So we took that same deal With that information we knew about the client and their spouse, reposition it, already address the weaknesses in that deal and put the mitigants in place, and we get it approved at a different level. That's just one key example of getting where we asked for the kitchen sink up front. I asked for one big conversation I've been having with clients lately is give me all your skeletons in the closet. I need to know everything. I need to know the goods, the bads, everything about you. Be as transparent as you can. So I don't have something that comes up at the 11th hour and I need to try to backfill and try to catch up on it because it's not, we're in a bad position at that spot.
Well, and like I've mentioned on my client that has done some gambling in the past and just like how that messed up his deal down the road because it wasn't properly disclosed for him when he was trying to do it on his own. Like little things like that. They can be red flags, but they're not necessarily problems if you can explain them up front. But when they come out like a skeleton in the closet all out of the blue, all of a sudden you're now worried about something. Maybe this is hiding something else as well. So the lenders and the credit committee, they don't like finding things last minute. And I think that's where we're also seeing a lot of where lenders used to kind of issue LOIs. Now we're seeing a lot of times they're wanting to send it for full approval before they really let you know on terms because they don't want to have that be turned down after they've promised an LOI.
Right. There's a lot more catching themselves. The other thing that I feel is happening, and is maybe because of the volatile market we're in, is there's a lot of changes going on in, let's just say, policies, guidelines, things like that, the upper level when it comes to concentration limits and funding and liquidity, all those kind of things behind a financial institution, all the multiple factors that they're not being relayed all the way down to every layer, or at least not in a timely fashion. Maybe they are, but not in the sequence to catch something up front in the origination aspect. That you get through to the end and go, oh, well, that's changed over, the last 3-4 weeks. If this would have been a month ago, we would have approved the deal, but we've now hit a concentration here. We're having some losses over in our portfolio over here. We're going to have to say no to this deal because of our prior experience. Not even prior experience, just prior things in our portfolio, other things that are not going the way we anticipate them to go. So that is one thing that we see is nothing to do with the borrower themselves, because we could flip that to another lender and get it approved. It's something that's outside of the borrower's control, outside of the loan originator's control. And you feel bad for the loan originator from the bank, my relationship manager I'm working with, and they go, sorry about this. Is not what I was told. I had one recently where they knew the location. I mean, they know the location up front when they see our package come in. And all the way through, we're getting everything done, going back and forth, answering questions for their analysts. And then all of a sudden they come back and go, this is out of our footprint. I'm like, how is this out of your footprint? Like,
What do you mean it's out of your footprint?
what are we talking about here? How is this
You've
out of
seen
your
this address
footprint?
for weeks.
Like, yeah, we're going to turn this down. And the other deal we're working on, I don't feel so good about it now because things are changing here. Like, nothing against the borrower. I mean, this one borrower was like a 4-to-1 debt service coverage ratio. But what are we turning it down for? What's the reason? And out of our footprint. But the footprint's been known all the way up front. So sometimes there's just a lack of communication inside the financial institution that is not a direct reflection on the borrower and their capacity to borrow and repay the loan.
Well, and like we've hinted on so many times, the market and the appetite changes that most of the time have nothing to do with our specific client on a deal. They just don't like hotels because they've been burned by hotels, or they don't like office buildings because they see since COVID, office buildings aren't as good. I mean, like it's not really about the deal. It's about perspective.
Their makeup of their own institution, and at least some of those where it's asset class driven is usually known up front. But we've also had some of those come up later on, like, well, we just had a deal fund right before yours, and now we are at our capacity in that asset class. You're like, you've been working with me for a month and a half. Like, okay, let's pivot. And this is why we always have our pivot in place. I think one deal we brought up a while back is there was a deal, great deal. We actually have been funding it. It's one we talked about. We funded all 5 phases with 7 different loans, and now we're taking out the HUD. They originally got turned down by a lender, and the local ish state of Washington people approved it, but when it got to the final credit decision person sitting in a different state, sitting in California, who's never been to Eastern Washington, does not understand the market, goes, this project doesn't fly in a town of that size. And Tri-Cities is not small when you think about adding Pasco, Kennewick, and Richland all together. But for them, in their mindset, that project will not fit in that market. And that's too nice of a property. We're not going to be able to get rents like that without reading the market data that's actually from CoStar and from local providers and showing the supply, demand, and the demographics of the potential renters in that market. They just shut it down because they just didn't like, that was too small of a market for them. We were on that one for months. We're like, how do you tell us at the end of the day that this is being turned down? You've never been to this location. You have no clue. Isn't that why you trust everybody else from you? If the metrics all hit, the metrics, the story, and everything else hits, why are you turning it down for something, again, that you guys knew up front?
Well, and it shows that like their perception of that market or this area was the whole reason. They didn't look at any of the data. They didn't look at any of the truths that you showed them. They just had their perception. But and that's what can be so dangerous about perceptions is that it can't be always built on real information.
It just goes back to what we were talking about earlier. You get those credit people who had a bad experience in something 30 years ago, and every deal in commercial is different. Every deal is, you can't say this deal in 2026 is the same as the deal in 2006. You can't articulate that. There can be some similarities, but the borrower is going to be different. It's not the same borrower. If you're bringing back the same borrower 20 years and they burnt you 20 years ago, fine, that makes sense. But this is a completely different borrower, different economic times. Even if we are in similar economic times that we were in a different market, things are fundamentally different behind the economy. Yes, history repeats itself, but not the same exact way. And every market's different. Every niche of the market's different of what's going on. And for some reason, these people just get it in their head that, well, we can't do this. No, Brent don't like the structure of the deal. I don't like the borrower. Like, what do we not put into the original write-up? So sometimes you just get biased opinion in there, and that is not justified for the real request.
And that's where it makes our job important and difficult at times, is having to have those conversations with our client after we've been telling them things are all moving along good with the lender. And then all of a sudden they say stuff like that. Yes, we can have the pivot. Yes, we can have the backup, but it's hard to get the client to understand that it had nothing to do with you. They're just not doing your deal now. So
the feedback
we're back to the drawing board a little bit.
They're like, we cash flow. I got great credit. I've always paid my debts. Like, yeah, it's nothing to do with you. It's nothing to do with you. And then the other fun one is always when you get, well, we've been dinged by examiners lately, and they're not liking these things. We need these extra. We changed our policy to address, we need more liquidity on hand. We need 10, 15, 20% of the project of liquidity on hand, yada, yada, because we're seeing other projects go bad in our portfolio that do not have these metrics. And that's fine. That's why we try to put so much in our write-up up front. So we can, if it's a no, I'd rather have a no. Are we getting better at working with our lenders so we don't get caught with our pants down in the middle of a deal? Yes. But is there things that are always outside of control, and the team that we work with over that financial institution, is there always things outside of their control that none of us knew was going to come up? Yeah, always. It's always going to be something that gets us all caught off guard and go, nobody saw that one coming. And it's just, and as a borrower, they start to feel like, oh my God, either A, there's something wrong with them. B, something wrong with us. C, they hate all lenders. And people then go, I'm just going to go to private credit. No, it's not always the case either, guys. Nothing to do with you. But as long as we're transparent on everybody's side through the deal, usually we don't run into those. Or if we do, we're always going to back up. We're flipped it over. We've lost maybe a little bit of time, but nothing drastic that's going to kill the overall deal. We have had some lately that have killed the overall deal, and this was changes that had to happen for our borrowers moving to a different lender. It was not the borrower's fault. It just had nothing to do with the beginning lender. This was a CDC. We had a CDC come down and turn down a loan, but then we flipped to another CDC and they said, "No, this is easy. We do this." And once we started unraveling things a little bit more, we found out the one CDC just didn't have the ability and skill set and team to be able to run through the complexity of our borrower's file. And because once I spoke to the other CDC, which is the largest CDC in the country, this was right up their alley. They laid it out up front. And like, oh yeah, well, you're going to now because of this, we're going to have to spread all 14 entities. And then I started taking that information, going off and see why the other CDC turned it down. They didn't have the capacity to be able to do this or the skills to be able to run with that much complexity on a file. So sometimes it is against the borrower. I mean, the borrower is doing great things, but then they have some complexity and or this unique rules with the SBA SOP that one can handle much easier than the other. And so those are some limitations back to skill sets and capacity at institutions or conduits like a CDC is to be able to get the job done.
Exactly. The even an SBA lender I was talking to this week already described it well. He's like, there's the rule of thumb for the SBA, but it doesn't read like a black and white book. It's very vague most of the time and all open to interpretation. So
I've always said that you speak to 5 SBA lenders, you can get 5 different answers. It's like speaking to an attorney. You go to an attorney, you go to 5 different attorneys with 5, the same question, you can get 5 different ways they're going to view that. And same thing with SBA, because not just the SBA, they also have their own credit boxes. And where the misnomer out there is, oh, it's SBA is backed by the government. What's the matter between Bank A and Bank B? Well, Bank A's got a credit box like this. Bank B likes this, a little bit more risk, because you're still taking some risk on the deals. And people don't realize that it's nothing to do with them. Again, it has to do with that lending institution. So our goal has always been here is finding those ones who, depending what asset class, what the borrower's profile looks like, who do we send this to so we don't have to run into those issues? Because in 2026, certainty is much more important than sometimes rate, term, and structure. If you have a solid deal that is, you can walk into 5 institutions and get 5 different proposals, great. If you have one that you're like, I need to be very selective because the borrower is only going to fit in the credit profile for a few different institutions, that's where we come into play and navigate that scenes. And that's where our relationship with our lenders come into play, continue research and conversations with them so we can understand what's going on and don't run into these last minute things that, and when we bring up some of these were earlier on in the start of our company. And we've got much better at pivoting. That's where we learned to pivot better. And some of these deals were just complete shockers, and we probably wouldn't have changed anything about our process today compared to what we did then. It's some things are just, I can't change. Sometimes you just got
sometimes you just
somebody
get
that's
hit with a cold curveball and you just don't know what happened to you.
somebody's just in a bad mood and they had a bad week and I don't know, their dog left them. I don't know what happened. They just want to say no to everything. And it's just, and that's why we try to build up that relationships with those underwriters and credit people to be able to, hey, if you got any questions, just hit me directly. Like, just not play this telephone game. You call the loan officer, just call me, email me directly. Let's talk through this structure and this deal before you say no, because you got your information and maybe there's something you miss. I'd rather have the question back. Hey, here's what I'm seeing. What are you seeing it different? Oh, did you go look at this? And when you go look at that, oh, thank you for pointing that out. Because sometimes they're very, narrow side. They're just looking straight in front of them. They're not looking at everything else going on. Yeah, it's a fun world out there in the credit, especially in 2026. I think the credit has become more rigid at some institutions and something we have to navigate better. But it's also important that the work that we do up front for our clients and working with these people who take a couple of weeks to get me an LOI term sheet back I don't mind that. And when I explain that back to the clients and talk them through the process, they're much more appreciative because they don't want a curveball coming up and like, yep, we've ordered appraisal phase one, all these things, and you get turned down in the 11th hour. That's nothing they want in there. They would rather go for that certainty and take another week or so up front compared to wasting months in the back end.
Because those reports, you all expect them to come back good, and you'd rather know that the deal's going to close after you have those rather than hoping that it closes after you haven't spent the money on those reports.
You just brought a quick point that I want to address is the reports are going to come back good. You know, has there been instances where a report has come back and killed a deal? Yes. We've had environmental reports that killed a few deals that nobody was aware of, and the seller and the buyers weren't willing to negotiate anymore to keep the deal going, which it was, again, those are shockers and surprises. Appraisals rarely come back wrong, but sometimes where they come back where it hurts our deals lately, it's not the value. In today's environment, value has not been a limitation. It's been more of maybe the NOI of how the appraiser is looking at it.
Mm-hmm. What
And when I
expenses
say
they're adding, or
the NOI, when we're saying NOI is more of ground up projects or stabilization projects that we're calculating as NOI, they're calculating NOI over here. And they're like, well, the lender's like, we have to go off the NOI of the appraiser. And then it kills the deal. And a lot of that is we like that feedback. So give me the appraisal early on so I can review it and do any pushbacks and see if there's anything the appraiser missed. And I've had that a few times where they've come back and I'm like, where'd you get those rents from? I go, I actually own a property management company in this town. And here's the rents we're getting on these similar properties. Oh, can you send those over to me? I'm like, here you go. And they go, yeah, we can rework the NOI because they were just, again, they had their blinders on, only looking at it one way.
what would we close and wrap with? Of maybe if someone's out here listening has a deal that's just sitting with a lender, and maybe they're worried that this is happening to them, what should they do?
Always have a backup plan. You got to have a backup plan in this lending world today. And asking the questions, did we address all the risks or weaknesses in this deal? Do you guys see any risk or weaknesses? How far is credit? What's your credit team looked at? Are they on board? Is your credit team on board? Where is it at in that process? That helps them go, oh yeah, well, credit, we're still friends. We have some issues, or credit hasn't looked at it yet. I mean, underwriters, everybody's got a different situation too. We got underwriters, but they actually just put together the packet and then it goes to a credit person. Everything's dependent on the institution, how they're set up. So as the decision makers on board on this, so every number if every number comes out great, like I anticipate them to, how is credit viewing this? Well, credit's still a little iffy on it, because X, Y, and Z. At least know that up front and go, okay, what's my probability? Okay, I think 75%. Oh shit, 75% is not great.
Probably should have a backup.
75%
There's a 25% chance I need a backup.
Yeah, 75% chance. If you're shooting 75% from downtown, pretty good, right? You're shooting 75%. You're doing pretty damn good. You're doing 70. You're only making 75% of your dunks. You might want to work on your ability there a little bit. Everything is in perspective of where you're at in life, and this is very time sensitive. 75% probably not going to cut it for you. If you're not as time sensitive as ground up construction, you could pivot away. 75% might be worth it for you if it's got the rates and terms and structure, everything you want. Go, I'm willing to take that gamble at 75%, whatever it may be. But everything is always situationally based.
Good advice. Well, this was a little longer than we expected, but I think it just shows there's always some emotion that's tied with it, both as on our end, trying to sell a deal that we believe in and getting turned down for a reason that we can't understand, to our clients being frustrated with it, to even the relationship managers that we work with. Like you said, it's frustrating when sometimes a deal dies and it doesn't always make sense, but it just did. And that's where we put a lot of time into making sure we always have good backups and lessons learned from all of these so that we can continue to improve and do better for our clients in the future. Any final thoughts?
No,
Leave us a
just
DM.
hit us a DM, like us, follow us. I'm looking forward to you guys in the next podcast. We'll continue to keep it live and entertaining for you guys.
Sounds good, guys. Take care.